I don't have the least doubt that the so-called wall of money will keep rolling. And China is an interesting question, whether an industry that produces in many, many of its parts turnover but little profit is really something that on a longer run should be a real investment perspective. But definitely this money is coming, is going, and is continued to be going. But once we think about, wow, is my asset really 18 times the annual rent, or rather 16 times? Is there all of a sudden a decent American government bond which is priced at 3.8% rather than the 2 that we have today with an further increasing dollar? Are there alternatives, and is the discounted cash flow all of a sudden rather to be discounted by 2 or 3%? At that moment, this entire wall of money will want to seek return, but what they definitely don't want is losing money. And at that point in time, that's what I call the great months of reassessment. They will come, and then this wall of money will be as stopped as we've seen it after the credit crunch, out of different factors. I have no doubt about that.
I think, speaking for the wider shopping center market in Germany, I think international capital has already changed the landscape. So in former times, a lot of shopping centers built by the German market leaders ended naturally up in a portfolio of a German open-ended fund or a leading German insurance company. And if we look back what happened, let's say after Lehman, nowadays we have a structure in regional malls and large-scale shopping centers in Germany which is not too different anymore from a UK structure. So there are not too many assets in single ownership. So we have a booming evolution towards JV partnerships. And they necessarily do not need 70-80% LTVs because they want to get their equity invested. And they very often have a long-term plan of 10, 20, 25 years. I speak about the likes of CPP, who acquired Centro Oberhausen. It was a 100% family business by the Healy's. Nowadays, it's a 50-50 JV between a French REIT and a Canadian pension plan. If we look at the PEP in Munich, it was in the portfolio of Deutsche Bank. Very good asset in Munich, protected against competition due to the planning legislation restrictions there. And nowadays it's owned by TH Real Estate, who represent TIAA-CREF, pension fund from the US, or American financial services provider from the US, and CNP, French insurance, 50-50 joint venture partnership. If you look at Ruhrpark, it was 40 years in the portfolio of Westfonds, closed-end fund from the Vestelbeek Group. They sold out all their closed-end fund business. This asset then was suddenly owned by Unibail-Rodamco and Perella Weinberg, 50-50 joint venture. If you look at Waterfront, Degi, you know it from good old times. So at that time it was known under the name Space Park. And suddenly it was owned by LNC and Resolution, a joint venture in a large-scale shopping center in Germany. If you look at Gropius Passagen in Berlin, it was owned by HFS, later on WellsCap, and also for 30, 40 years. And nowadays it is owned by TIAA-CREF and CNP. So I see that the international capital has changed the market already in the shopping center sector. That brings new requirements for the asset managers, who suddenly have to report to 2 shareholders, longer decision processes, and a little bit of different approach in asset managing these kind of assets. When we look at who is entering the market right now in this sector, I find it quite interesting that M&G Investments have just done their first acquisition in Germany. They represent the capital from Prudential, and they are a player. And they've just bought a retail park for about 50-something million. It's a small lot size, but a big player has entered the market. We see a lot of North American capital waiting on the sidelines, looking at major shopping center deals in Germany, and also Asian capital, although I'm a little bit skeptical still about the Asian capital because I don't see it ending up in retail acquisitions. I see them looking at a lot of retail properties, but they haven't brought so much to the notary yet. Yeah? So I think there is a tendency that maybe the North Americans and the UK investors are a little bit more familiar with the German market and can act quicker. Let's not forget the European REITs. One of the biggest transactions in the first quarter was the closing of Corio, the takeover by Klépierre. And, well, Klépierre have arrived in Germany now with a small portfolio of 5 shopping centers, but they are strong. They have a lot of capital, and they have, with David Simon, a strong shareholder who is the biggest shopping center operator in the world. So I think they will not give up this market easily, and they will try to compete with Unibail-Rodamco and ECE here in the German market. There are Dutch fund managers sitting on equity to be invested in the German shopping center market. There are sovereign wealth funds, Asia-Pacific funds looking at things. Plus, ECE have, for example, launched a European shopping center fund with international capital behind it. They will also be active. I think at the moment, so I'm told by the agents, about 50% of all deals are made by domestic players. And I mean, Union Investment is the best example for having a nice shopping center portfolio of 44 good shopping centers. And Deka will be active as well. But there are still 50% left of the market. And this is where I think a lot of international transactions will happen in the second half of this year.